afternoon. I'm Susan Riitala. I'm a partner at the Assev finance team at Reed Smith, where I specialise in transactional shipping. I guess we'll start the easy question, and I'll ask the panel to briefly introduce themselves and tell us who they are and what they do.
Yeah. Should I start?
Good to start,
yeah. So my name is Magnus Assev. I'm a partner in the investment banking team of Arctic Securities, working on all types of products towards shipping clients.
Jim Cirenza. I'm with D&B for the last 11 years, responsible for the equity and fixed income sales force, and it's my 40th year in the industry.
My name is Wilhelm Gedde-Dahl. I've been with Fearnley Securities in Oslo for the last 10 years on the investment banking team and heading our shipping efforts.
Hi, good afternoon. My name is Stratos Desypris. I'm the Chief Operating Officer of Navios Partners, and I've been in the Navios group for the last 16 years.
Paulo, Almeida, Chief Investment Officer of Tufton. We're an investment manager focused on shipping with about 65 ships worth, a little bit over $1 billion in a number of funds, mostly private, partly public. We heard the LSE speaker this morning mention our listed fund. Before Tufton, which I joined nearly 14 years ago, I was an investment banker myself, primarily with UBS.
Thank you, everyone. All right, I'll start with you, Paulo, if you don't mind, from a sort of wider perspective. What are the biggest challenges and pressure points at the moment that you're seeing in terms of investment shipping? I mean, I think we have an interesting panel here because we have Stratos from the owner side as well. But I'll start from the investor side. So, Paulo, what do you think are the biggest challenges?
Well, I'll split that question into two questions. One, we're an investment manager focused in shipping, so we look at it from one perspective in that we have capital that we expect to invest in shipping. How best do we do that? And then I'll take it from the perspective of our underlying investors and generalist investors in terms of how they look at shipping. Perhaps one common issue today is clearly how to deal with decarbonization. And I don't think anyone has the answer to that. If Dr. Stopford doesn't have the answer to it, then I think, and he's the smartest guy in the room, I don't think any of us do, but we know it's going to be a long voyage. Even if we think about 2050 as a target, we do have a while to get there. The ships that are likely to produce no emissions in 2050 don't necessarily need to be built for another few years, if not longer than that. But that's a common problem. In terms of someone putting capital to work in shipping, I think a challenge today is there are very limited clear value opportunities today, unlike most of the past 14 years or so after the financial crisis. At some stage, either container ships or bulkers or tankers or some niche market or several niche markets looked very attractive on a value basis with some expectation of demand recovering and lower supply, meaning that a ship bought at a significant discount to depreciated replacement cost or some measure like that was likely to appreciate over the next 5 to 10 years. I think today it's not quite clear. There aren't clear opportunities like that as there have been for most of the past 14 years where container ships are still significantly above depreciated replacement cost. Tankers are now above, although they weren't 6 months ago, and bulkers are around that level. So clear value opportunities aren't there. If then we look at what a generalist investor thinks about, clearly in the UK, investors, where most of our investors come from, a lot of them aren't even thinking about what industry to invest in over the past few weeks because of the huge turmoil that we've seen here. But clearly they're looking at, do we put capital to work in old energy, in new energy, in shipping, in hotels, and all sorts of businesses. And today we have a very, very complicated macroeconomic and geopolitical situation, we think it's one that actually suits shipping quite well, and maybe I'll talk about that a little bit later. But there are a significant amount of challenges. However, that's likely to be good for people who are already invested. For people who are already invested, especially if they came in at attractive valuations, uncertainty is good. It's always good for fewer people to be ordering vessels.
Thank you. Stratos, would you want to share your view as an owner?
Yeah, I mean, we also have the ship owner's perspective. I mean, we live in challenging times. I mean, we all recognize that. What we are seeing is that in the West, the major impacts of the pandemic are fading away. I mean, today here we are having our event, our forum live. It's something that we could not even imagine for the last couple of years. The situation is a little bit different in the East, where you have China still struggling with the zero-COVID policy. But most importantly, we have the war in Ukraine. And, apart the tragic loss of human lives there, the consequences of the war and the related sanctions, they cause supply shocks. And these supply shocks accelerate inflation and rising interest rates. And also we have the energy fear, the energy question, whether there will be energy availability, energy security, and the cost of energy, especially here in Europe. So these are challenges that we face in shipping as ship owners. And apart from that, as Paulo already said, we have the increased capex that will be required in order to meet the decarbonization, the new regulations that are coming into play. So ship owners will have to spend capital in order to make their ships comply with the new regulations. And I think these are the major things that we're facing right now.
Thank you. Well, let me ask you this. What can ship owners who are looking for a new investment do to ease some of these challenges? What will make it easier for you to want to invest?
Well, I just want to add that, before we go to the next one, that it's really a very good set of opportunity at the moment. Shipping and the capital markets has been through a decade where the last sort of cycles where you could raise capital for growth was based on an expectation of earnings and asset values going higher. But this time around, it has been supported by real solid earnings, and earnings have stuck at elevated levels for quite a significant time. At the moment, it's a very healthy equity capital market for shipping. Of course, the noise in the overall stock market is pulling in the opposite direction, but investors are wanting to invest because you have very solid earnings supporting the investment opportunities. Yes, as Paulo said, the sort of deep value opportunities are not there anymore, but you can quickly reduce your exposure on getting in at these levels through strong earnings. And as soon as the visibility on earnings also get better, we believe in a continued strong spot market, and that will at some point also lift the period charter rates. We think there's further upside on asset values.
Jim, I will come back to you in a moment. I have something earmarked especially for you.
Oh.
But Magnus, can I get your thoughts on what ship owners might be able to do?
Yeah, no, I completely agree with Wilhelm, but I would argue that kind of earnings is one thing, but I think actually returning capital to investors and having capital allocation discipline is kind of the key part of the equation. And I think we are fortunate enough to be in a situation where essentially ship owners are prohibited from ordering vessels in the smaller sizes in the commoditized segments, such as tankers and bulkers in particular. And I think that's obviously thanks to the container owners, but also due to the fact that there's so much uncertainty regarding the fuels of the future. So if you are an owner with 5 to 10, maybe 15 MRs in your fleet today, you're taking a huge gamble if you're putting kind of the cost of a dual fuel propulsion system on top of the cost of a conventional new building today. So I think that has enabled a lot of owners to actually to de-lever their balance sheets, which is a super healthy thing because it creates more stability. And even though shipping is an immensely volatile business, I think getting that stability enables it to be more of a long-term hold kind of strategy for investors. And I think that will open up a significant amount of incremental demand. And I think there's so many good examples of kind of companies across all sectors, and you as well, Stratos, that kind of you've been through very difficult times, but now I think we are in a kind of a truly unique, and I hate to say it, but this time is different because owners are in a more kind of healthy state, and you are in a position to actually return capital to investors rather than spending that first dollar to go to the yard because you're keen on more ships, right? Because you have a bias of always being more positive than the investor are. So I think that's kind of what will drive demand going forward, and people will at some point realize that, right? And that's where you get kind of the focus on actual earnings and yields rather than, as Paulo said, as on price to NAV or whatever kind of historical measures.
Thank you. It's like you've changed tack to capital markets more specifically. 2021 was a big year for debt and equity raises, but what have we seen this year in terms of equity and capital market transactions? How does that reflect the investor appetite in shipping? Jim, you can tell this question's coming to you.
We miss it. We miss 21. And just for the history of the world, I mean, the world has never raised as much capital as it did last year. In the US, between investment grade, high yield, companies raised over the last 2 years about $3 trillion a year in the US. We raised something like $840 billion of equity-related capital in the US last year. That was a double off the old-time record. And then you can throw in term loan Bs and some other stuff. But the amount of capital raised last year was off the charts. And the amount of capital raised this year is not. You know, as of last week, we've raised $87 billion worth of high-yield paper in the US. A year ago at this time, the first number was a 4, and then 87. And on the equity side, the IPO business is down about 90% year on year. So the capital formation has been horrific. I think the major Wall Street firms have done clients a massive disservice by telling them to wait. You know, bonds mature. Equity, maybe you can wait, but bonds mature. And so if you kick the can down the road for the first 9-10 months of this year, at some point you've got paper to replace. And so all that's happened so far is about a 300-point move in the Treasury curve without a significant widening in credit spreads yet. And obviously that could be the next shoe to drop. So the cost of capital for the companies that we care about are going up a lot. This year hasn't been horrific for shipping, and it's been actually pretty good for energy. Among the few sectors you can say that. A lot got done in LNG, you know, Accelerate IPO, Cool Company IPO, a few follow-on offerings, a few ATM programs, but the market hasn't been closed to shipping this year. But once again, it's in the minority. And I know that equity values are down, and I know that yields are up. But every quarter that the major firms tell clients to wait, to me, is just another expensive quarter unless you can wait a long time.
Just a few additional comments to that. I totally agree that the gross numbers that has been raised in the public equity markets doesn't really reflect the state of the shipping equity capital markets. The deals that have gone to market has been very well received. Investors coming in early in the books multiple times oversubscribed. IPOs within LNG shipping, as was mentioned, car carriers, FSRUs, follow-ons for tankers, block transactions in container shipping companies. So I actually think there's it's been more sort of a lack of a desire on the shipping companies to raise capital. You have seen tremendous earnings small capex programs, and really not that much for the companies to raise capital to finance. So I think that's really the reason for the low gross numbers in terms of equity capital raised. You also see in the daily turnover liquidity in the shares of the listed companies. It's gone through the roof, at least if you compare to historical numbers. Admittedly, for some shipping companies historically, liquidity has been low, but no, it's that's the key takeaway from our end at least.
Thank you. I think Jim mentioned that the market is not closed for shipping, and we've talked more generally about what the ship owner can do. But if you are now a ship owner who's thinking, I'd like an IPO here, I think that would be a great idea, but actually maybe not right now. What are the things they should be thinking about? Where are we seeing an opportunity for a ship owner who might want to actually go out into the capital markets? I'll open that up to the panel.
Can I start?
Yeah, please.
Yeah, so just one thing before, although it is related to this question, Stratos and I only got to answer the question about the challenges that we face. I don't think either of us are negative. I think we both think that there are excellent opportunities in shipping. I touched on it when I said that despite all of these negative macroeconomic and geopolitical issues, a lot of them are actually positive for shipping. I didn't have too much to add to what Wilhelm and Magnus actually said about the positive aspects of shipping. I will just add that some of the points that were discussed in terms of returning capital to shareholders, for example, being disciplined in capital, being disciplined in allocating and reallocating capital is something that we as an investment manager obviously prioritize very, very highly, and it's something that we've been doing, including in our listed fund here in London. In terms of, so I can't answer as a ship owner because I'm not a ship owner. I was a naval architect once, but I am no longer, and I'm not a ship owner. But in terms of a shipping investor, in terms of what we can offer to, in terms of structure to the markets, capital discipline is very important, and alignment. So you want to see a structure where the ship owner, sponsor, whoever it is, or investment manager has a lot of their own capital in the structure. You want to see other forms of alignment in terms of, they get paid when they perform. They don't get paid for collecting assets or buying ships or selling ships or ordering new builds, but mostly based on performance, and they return capital. And I think that's one thing that we are seeing more and more. We've seen that come back now, including with a lot of the U.S. listed companies that used to return a lot of capital, then spent a long time where they probably wanted to return a lot of capital but didn't have any to return, and now have gone back to doing that. But at least they're back in the right place.
So before we carry on, an admin point that the clock has disappeared, so we don't actually know how much time we have left. But we will carry on in the meantime. Stratos.
Can I add to what Paulo is saying? I mean, shipping has been volatile, and it has extreme reactions to some global events. The good thing is that not all segments react on the same way. So usually you have segments that are performing well and segments that are not performing well. So I think that in order to be able and return capital to shareholders and have a stable and base, cash flow and predictable cash flow, diversification is key. I mean, in Navios, we are diversified in 3 segments: tankers, dry bulk, and container ships. And we see the movements of these segments, on a more counter-cyclical way. And, diversification has certain benefits, at least from the ship owner's perspective. First of all, you can optimize your chartering strategy and create a sustainable profitability on your fleet. I mean, you can go longer term in segments that are performing well and be patient and wait and go shorter durations on segments that are not performing well. There is also the fact that you can counter the cyclicality of the volatility on the asset values. So that creates a balanced strength and a balanced stability. So, vessel values are very volatile, but having different segments, you mute this volatility. And the second, and I think it's one of the most important elements that we see on diversification, is of course the capital allocation. You can capture the cyclical opportunity and have an optimal capital allocation. You can use the cash that you are earning in segments that are performing very well, and use this cash in order to buy vessels on segments that are on distress basis. And usually these are the most attractive and most powerful investments that we can do, investments at the low part of the cycle. So all in all, having a diversified vehicle, having a diversified company, that creates stable returns and you can get stable returns and even performance, although you have uneven segment performance.
I'm actually going to touch on something that Paulo said about the macroeconomic elements and uncertainty. And obviously, there's not a surprise to anyone that there is a lot of it at the moment. The UK is doing a good job of adding to it this week. It all sort of sounds quite gloomy if you look at it, but what are there in terms of opportunities for shipping that might come out of this? Maybe we'll just go through the panel from the end, if you don't mind.
Was that
Well,
Paulo?
Well, I'm not going to put a very specific forecast on it time-wise, but certainly dollar-wise, it's a huge opportunity, and that's decarbonization, which I don't think there's too much need to repeat, some of the challenges as well as opportunities that Dr. Stopford mentioned already. Now that's a clear opportunity, but in an uncertain environment where two key concerns of inflation and geopolitical risk are both factors that not always, but often do result in strong cash flow or at least strong asset value appreciation in shipping, makes a diversified investment portfolio in shipping with low leverage and with some charter coverage, one that we think is very, very attractive. Although there are some major exceptions to that, this sort of environment with geopolitical risk and potentially high inflation is one that can be very positive for shipping, especially when, with the challenges of decarbonization, there's unlikely to be many ships delivering over the next 5 years.
No, I mean, Paulo is very correct on that. I think that, investment opportunities in shipping, they always exist. Paulo is very correct to say that it's very difficult today to do an assessment on investing on new vessels. Vessels, they have a useful life of 20-25 years, so you do not want today to make their own decision and get stuck with a vessel that has a useful life, which is in the wrong place. So in this case, I mean, we see the regulations that are coming into effect from 2023. There is a lot of the parts of the fleet that effectively will be phased out. There are some things that we can do as ship owners in our current fleet, doing more slowdown on the fleet. We can, change the propellers, make some tweaks in our vessel engines, and this will result to about 30% of the reductions that are required. But what is important to see what's going to be the next generation fuel in order to be able and comply to the regulations as we go forward. And we are not there yet. I mean, we are experimenting with a lot of different fuels. I mean, ammonia, methanol, hydrogen are things that we are seeing today. LNG, we feel it's an intermediate fuel. It will take you only through to the next step, but it's not going to solve the problem. One thing that we see in shipping, unfortunately, we're not a subsidized industry. So unlike airlines or cars that they receive subsidies in order to do their research, in shipping we're not subsidized. So we will have to wait and see what is going on and what is happening on the long-haul travel. and what's going to be the resolution, especially on the airlines. And most probably this is something that we will also adapt in the shipping space.
I think if the current turmoil, if you will, continue as it is now with high energy prices and inflationary pressure, I think it's primarily a positive for shipping. Paulo mentioned the inflation aspect. High energy prices is also positive for shipping of commodities that goes into energy production. There's nothing better for a ship owner than the cargo being transported, being expensive. Then the cargo owner and the trader or the shipper doesn't really care too much about what freight is costing, and that's what we're seeing at the moment in many segments. If those elevated commodity prices lead to a demand destruction, then of course the picture is a bit different, and that's just part of what goes into the investment decision at the moment in shipping. I think balancing those two aspects. Downside protection is a low order book, low yard capacity, low leverage in general for the players. So if we had a correction, it shouldn't get too ugly, we think. But the positive in terms of opportunities is that, of course, asset values will come down, and you have a more, in a historical context, attractive entry point to grow your fleet further.
Listen, the supply side is easy to understand, the order book's easy to understand. The demand side is much more difficult to understand, and all these disruptions often create different patterns, and it's been a volatile year in terms of trade patterns, and I'm pretty sure that we haven't seen the end of the volatility. Things that are different, whether you take oil or other products, or iron or coal, inventory levels for most of them are below 5-year averages in the Northern Hemisphere. So tell me what this winter is going to be like, and we'll figure out what the trade flows are going to be. We just heard about coal going from Indonesia into Italy. That wasn't a trade pattern we probably thought about, 10 months ago. So all these changes in trade patterns, you think about the strategic reserves in the U.S. and where we've taken those levels down, and ahead of the election in the first week of November, we're probably going to take them down a little bit further. That'll change the way that certain trade patterns work. And the better that analysts can help investors understand the demand side, the better companies can help investors understand the demand side, great. The supply side's pretty easy.
Yeah, no, I think there's been a lot of smart comments made, but relating to your point, Wilhelm, in terms of the actual, I think people have realized that the value of securing transport for cargo is kind of increased massively due to this kind of recent state of the world that we now have, and I think that is something that is obviously very positive for owners and hence also for investors. And I think also the general public has woken up and realized that kind of shipping is a major part of global trade, and hence also kind of that they see it as an investment opportunity. So, yeah.
Thank you. I don't think that we could leave here today without touching on sustainability. We've seen a lot of talk about design principle and green bonds and things like that, but how much of that are you actually seeing in your day-to-day life at the moment? Where do you see that developing in the short-term future? I'll open that up to whoever wants to pick that up.
I'll start first. We killed it last year with sustainable bonds, killed it, even in shipping. Container shipping supplier raised a decent amount of money in Norwegian bonds on their route to 70 new build orders in containers last year. Even chemical tankers, we did sustainability bonds, and so the sustainability influence on the debt capital market side, on the bond side, I think has a long way to go. The sustainability influence on the equity side, I think, peaked in the first quarter of 21. You know, couple things happen. Obviously, the number of companies that qualify for being a sustainable investment grew at a growth rate that was much greater than the assets under management and the funds that were chasing them. And the best thing you can say about the assets under management of the funds on the equity side is that the ESG funds in Europe, their assets declined by less than most other asset classes. But once again, you've got a universe of securities. So the equity side, I think we're beyond the peak of influence on valuation. The bond side, I think we have a long way to go.
I think Jim is right in that it's primarily the debt market with the bond side that has this important feature, and we'll see more of it. Not that we work with bank debt that much, but that's also our impression from speaking to the ship owners, that the banks are putting a lot of pressure on their clients to comply with similar call it covenants or measures. Agree that on the equity side it's not that easy to measure through the deals or investments that we source to our investors, but what we tell the issuers is that, you know, it's important to benchmark with the best in class on ESG, and so that you at least do whatever you can with your current asset base to be as green and you know, low carbon footprint as possible.
Yeah, I think it is with kind of other stuff as well, is you have to have a clear value proposition towards investors, and especially kind of on the public equity side, if you're going to market with a deal, you have to have something that is doesn't exist in the market, or that kind of brings a kind of specific value to the investors. And if you don't have if you're going with kind of older assets, or if we're going to kind of do stuff that is outside of the typical ESG pockets of investors, then you have to kind of have other value elements that weigh up for that, I think.
I think that I agree with with Jim's data point or anecdote about the first quarter of 2021 sort of being peak ESG. That's probably right, but I think that the shipping industry and all of us players in it do have to appreciate that at some point sustainability does become an existential issue for us, for the whole industry, and for individual companies. Clearly, the geopolitical issues in the world today sort of trump any short-term issues about decarbonization and moving away from coal, for example. But having an overwhelmingly UK and continental European in investor base, having a sound sustainability set of policies and targets on emissions reductions, on crew health and safety, is not quite an existential issue yet in terms of raising capital from institutional investors. It's pretty close to that. Maybe it's dissipated a little bit because of the unique geopolitical situation that we're in today, but it soon will be again. And I think the industry cannot underappreciate how important it is for the long term.
I just want to say here that from our perspective at least, we are starting to see a fundamental change on the way capital is allocated, both from the investor standpoint, but also from the financing side. And I mean, we are seeing more and more of this sustainability-linked financing, that they set specific targets and this reduces or increases your cost. It's not to the level that we want it to be or it's going to be in the future, but I think we are starting to see increased penetration of this sustainability-linked financing. Also, what is very important is that companies are now being much more transparent on their ESG. they're doing, at least annual reporting of their ESG initiatives, and it's much easier for people to evaluate better their good standing and how they do on ESG. On the banking side, we see the banks that they are applying the Poseidon principles, and this has changed a lot the landscape on the vessels that are being financed. What we are seeing now is that older vessels, less fuel efficient or with more carbon emissions, they're struggling to get financing. And they're struggling because also the bank does not want to have a vessel financed that in a couple of years' time maybe this is out of the market. So we see that newer vessels, more modern vessels, are getting more attractive financing, more attractive terms. And also this is, for us as ship owners, this is a thing that we need to take care of. We need to manage the age of the fleet. We need to make sure that we have modern fleets. We need to make sure that we have the fleets that have the most recent technological advancements. And it's going to be much easier also from our perspective to be able and meet these requirements and be able to go to the next level. So I think we will see this trend growing a lot in the future.
Thank you. We've got a couple of minutes left, so I'll ask for a brief response from each of you to this. So if we do this panel again this time next year, what are we going to be talking about? Magnus, I'll start with you.
I think we'll probably speak about a lot of the stuff that we've spoken about this year, actually. I don't think kind of that much will change. I think there will be still there will still not be a conclusion on how to kind of move towards to kind of the green shift or which propulsion system to kind of go out in order. And I think earnings will still be strong in kind of all segments within shipping, and I think the public players will have kind of returned a kind of significant amount of capital to investors, and I think the only difference will be that hopefully there will be kind of even more both equity but also debt investors in the room.
This time next year, we're probably about halfway through the new build program on the container side, so I think we'll be talking about what the shipyards are going to build next, because they're not going to build nothing.
I'm also quite positive the next 12 months. I think most segments will be seeing decent earnings, and that also on the dry bulk and container side, where it's a bit more uncertainty at the moment. The market will have found the floor, and it's easier for investors to evaluate also going more long in those segments as well.
Susan, unfortunately, I didn't bring my crystal ball with me, so I will have to make up something. I mean, really, what we will be discussing next year depends on how certain events will evolve this year. I mean, we have to see how the war in Ukraine will develop, whether we will have a normalization on the restrictions, on the global trade restrictions, or there will be even more sanctions, I mean, depending on how this will develop. We have to see how the COVID will develop also, the COVID situation. The pandemic in the West is fading, but in the East, we see that there is still the zero COVID policy. So we have to see whether China will come back, and this will have a boost on, especially on the dry bulk. And, last but not least, there are fears of a recession. So if next year is going to be a recessionary economy, we're going to have a totally different discussion. And, with demand and in all segments basically being very limited. So I think the resolution or not of all these events will dictate also our discussion for next year.
I think there will be a couple of things maybe, and I don't disagree with anything the other panelists have said that we would think about or we talk about a year from now. We all hope, and I think we do expect that listed companies especially will return a lot of capital to their shareholders. I think nearly all of them have pretty sound prospects, especially in the tanker space. I think also, though, what we may talk about a year from now is new sources of capital, more long-term institutional investors will have started to come into the industry primarily to finance decarbonization. And we at Tufton will be part of both of those trends, returning capital and putting new capital into the industry for decarbonization.
Okay, thank you. That's out of time. Thanks very much, Panel.